Hello, this is Money Matters. I'm David Crowell from Mortgage Network, and I'm going to speak in this segment about the emerging developments in interest rates, which have been quite striking in the past week. This segment is being recorded on May 16th, and that's Wednesday, May 16th, so that will give you guidance relative to the market and the news. Yesterday, 10-year Treasury yields topped 3%. They went all the way from 2.99% to 3.08%. Doesn't sound like much, but in the world of international debt, national debt, and mortgage-related consumer debt, that was a huge increase. It's also a psychological barrier that is of great importance in the trading of debt instruments. So, what does that mean to you? It's the biggest increase in the underlying 10-year Treasury since 2011. 2011, 2018, 7 years. It's roughly corresponding to the rise in the U.S. equities market, in the stock market, which has been on a bull run for the same period. The bond market basically dictates, in opposition to the equity markets, it dictates the cost of money to you on any given day. For the past 7 years in the mortgage business, in Mortgage Network, my business, we have had record low interest rates. And when I talk about interest rates here on the show, I try generally to be referring to 30-year fixed rates, since that gives us a common denominator to compare the past with the present and to speculate about the future. The 30-year interest rates last summer were 3.75%. Today, on May 16th, they are 4.75%. They're a full percentage point higher. The U.S. 10-year Treasury was at 2.4%. It's at 3.08%. Significant increase. The way to look at these increases is to look at them as a percentage of the whole. So a 1% increase in mortgage rates from 3.75 to 4.75 may not sound like a lot. What's 1%? But when you think of it in relationship to where it was at 3.75, it's a 25% increase in interest rates. So if somebody said that your grocery bill is going up 25%, you would certainly take notice. If somebody says that your mortgage rate is going up 1%, you'd be inclined not to take notice. So you can see the difference. Now, the importance of all of this is that the cost of housing, the cost of automobiles, the cost of mortgages, various of the underlying financial structures and the consumer costs in all of these areas is linked back to the 10-year Treasury. It's the best single indicator. I mean, if you're a scholarly type or a little bit of a nerd and you want to find out on any given day what's happening with interest rates, the place to go, the place to Google is 10-year Treasury interest rates. That's the best indicator. Not in terms of what is the actual rate, but in terms of where it is relative to where it was on the day before or the week before or the month before and so forth. It's the relative position that matters. So anyway, interest rates are going up. There's another important interest rate that's mixed in with these other two, which is the Fed funds rate. The federal funds rate is the the interest rate controlled by the Federal Reserve that it dictates for interbank exchanges and for banks to borrow money. That rate has gone up from nearly zero to 1.75% as of yesterday, 1.75% from nearly zero about 3 years ago. So it's gradually going up. And the forecast is for the Federal Reserve to increase its rate in 0.25% increments, another 2 times minimum, 4 times maximum within 2018. So this is a fairly rapid rate of increase. So 1.75% moving to 2.25%, 2.5%, 2.75%. Again, what does it mean to you? If you have a equity line of credit, you'll know exactly what it means to you, because every time there's an increase in the Fed funds rate, there's a corresponding increase in what we all know as the prime rate of interest. Banks lend typically at 3% for short-term money like equity lines and cars and things, at 3% over the Fed funds rate. So if the Fed funds rate is 1.75%, which is what it is today, then the very best bank lending rate would be 1.75% plus 3%, which would be 4.75%. And I'll wager you, if you went into your local bank and asked what the price of a home equity line of credit is today, it would be 4.75%. 4.75% also happens to be the interest rate for 30-year fixed rate money today. The forecast is for the Fed to increase 2 or 3 or 4 times in the course of the next year, which means that your home equity line of credit, the very, very best home equity line, will be going up to 5.5% or 5.75%. So these are numbers that we haven't seen now for quite some period of time. Remember that the recession took place, it grabbed hold in 2008, it decimated the economy in 2009, a tentative recovery began in 2010, so that's 8 years ago, and we've had very, very low interest rates, extraordinarily low interest rates in the 3s ever since. We've now broken out, and the economy is showing signs of inflation, has full employment. There is a huge debt supply, and in other words, companies are doing well, they're borrowing money, they're expanding. And the combination of all of those factors and features means that interest rates are on the rise and are going to continue on the rise. Jamie Dimon, who is the Chief Executive Officer of JP Morgan Chase, believes that interest rates will be topping, that the 10-year will go as high as 4%. That's another 25%, another 33% increase over the next year. All of this adds up to the importance right now in your lives of taking a look at your debt situation, taking a look at your mortgage situation, and anything that might possibly be smart to do at this time. Any refinance activity, any debt consolidation activity, any change of a adjustable rate mortgage to a fixed rate mortgage, anything that's at the back of your mind that you've been meaning to get around to doing needs to be done now. In the trailer to the show, you will see the telephone number and the name of the company. It's Mortgage Network, and we will absolutely take care of any questions that you might have. Just call in and we'll have a chat, and I'll give you an assessment of whether I think it would be smart in your case to do a debt consolidation or a refinance or a reconfiguration of your debt. Now is the time. Rates are most definitely continuing up. Okay, this is David Crowell from Mortgage Network, and speaking to you from Money Matters. Thank you very much for listening, and have a great day.